is yours now.
Let me just start by saying, saying what my thoughts are on public debt or sovereign debt. Public debt is an important way for countries to plan for and meet their financial and economic obligations, using financing instruments and investments to enhance and create growth and development in countries. However, it is important that not only important, it's critical that governments are able to continue to service their debts and that their debt burden remains sustainable on an ongoing basis. But how did we get to where we are now? Within this the theme of this conference, Africa's debt conundrum and the infrastructure deficit. How did we get to this point where we have a significant number of countries having domestic challenges? In my view, I will say it has to do, first of all, with the time when, before the poly crisis that we're facing, we had a time when interest rates were so low that fund owners had funds, especially in Europe and the Americas and such like places, earning negative interest. So interest rates was very low, and the projection at that time was that interest rates will be low for a very long time. But of course, we got visited with the COVID-19 pandemic, and global public debt was already somewhat high prior to the COVID-19 pandemic, because there was a rush to borrow because funds were available, they were cheaper, and the development need was large. So data indicates that by 2019, global public debt surpassed levels last seen in 2007 by about 23%. But nevertheless, pre-pandemic expectations were that countries will benefit from the low inflation as well as low interest rates environment. And in response to the high demands as a result of the pandemic, there followed also the Ukraine war, of course, crash in crude oil prices that affected some resource crude oil products producing countries, and several other crises, including high inflation rates occasioned by the quantitative easing carried out by the Fed. So in response to the high demands and as a result of the pandemic, followed by the poly crisis, there was a sharp acceleration of debt. Global debt had declined between 2017, had increased between 2020, 2021, as well as 2022. And according to UNCTAD, global debt had increased, both foreign debt as well as domestic debt. Domestic bank holdings of domestic instruments had also increased during the pandemic. So the debt were not just sovereign debts that had increased, but also domestic debts held by banks in a number of countries. But while public debt is growing faster in developed countries, developing economies face more vulnerabilities to external shocks, and therefore we were faced with higher cost of debt. For instance, the average African country borrows 4 times higher than the cost of borrowing for the United States and 8 times higher than the cost of borrowing for Germany. So as an African country, you go to the capital market, you are just hit with a much higher cost than other countries, even countries whose economies are not as strong as yours. So during this crisis, a high number of countries, especially in the African continent, were downgraded by credit rating agencies, despite accounting for as low as 4% of the world's cases. And this downgrade by the credit rating agencies obviously has the impact of higher cost of borrowing for the African countries. So as of June 2023, amongst the low-income countries, 11 countries are in debt distress, and 25 countries are at higher risk of debt distress. Efforts to provide debt relief, such as debt service suspension initiative undertaken by the G20, ended in 2021, but the call for suspension of debt by the Brentwood institutions is still on, and also there's more support for this call, providing that countries are prepared to undertake significant and ongoing reforms. So in my time as Minister of Finance, I've seen firsthand the impact of debt on an economy, both good as well as bad. Managing debt service and budget deficit was a constant requirement to prioritize domestic priorities or follow through on commitments made to international commitments. Sadly, the most impacted by the high level of debts are citizens of the affected countries. And due to this need for trade-off between servicing debt as well as being able to service the financial and developmental obligations of government. But let me then speak to the constraints to domestic debt. Debt is unavoidable when countries are faced with national priorities and the need to address high levels of poverty and inequality. However, the conversation has been to consider external debt in local currency to avoid the high impact of external shock to exchange rates, but more importantly, to move towards increased domestic debts and reducing external debt. Foreign debt investments are attracted to foreign direct investments, beg your pardon, are attracted to robust and deep domestic capital markets, strong financial institutions, and sound banking and regulatory policies. Equally, domestic investors thrive in the same environment. However, many investors in this same environment struggle, such as the business environments are not friendly enough. A country, therefore, cannot develop without some reliance on debt and foreign direct investments. However, equally as important is the ability to rely on its domestic capital market to raise revenue through tax collection as well as through various types of debt instruments. This is, however, some of the constraints and how we can handle them. So how do we handle these domestic debt constraints? First of all, debt has a direct impact on the balance sheet and earning potential of financial institutions and also of nations. Capital losses also become elevated if the value of government debt exposure deteriorates. The banking sector needs to be well capitalized enough to absorb without relying on recapitalization from governments. In the event that debt needs to be restructured, this will have damaging impacts on financial system, such as lack of confidence for the government to provide government guarantees or liquidity in the interbank markets. While important domestic debt while it's important to take domestic debts, this also equally has to be approached circumspectly, with care and with caution, as a high volume of exposure of institutional investors to domestic debt has its own challenges. For example, when your domestic market is attractive, you have foreign investors, mostly portfolio investors, that would come to take advantage of the market. But once there is a shock in the system, the investment flies out and leaves your market struggling. So there has to be a way to find a balance to make sure that the reliance on domestic capital markets doesn't become an over-reliance. And also, we have to also look out to make sure that we're not crowding out the private sector. The government in its borrowing is not crowding out the private sector from borrowing within the financial systems in countries. High level of domestic debts also have an adverse effect on economic growth and on development. Less financing towards domestic priorities means less financing towards infrastructure development and also towards improving on basic public services such as health, energy, water, and sanitation. So how do we address these domestic debt challenges? In my view, first of all, and very importantly, is to have a proactive debt management strategy or debt management regime. Countries can apply different options that are internationally accepted debt resolution frameworks, which allows for debt to be restructured or refinanced, but also debt management frameworks that ensures fiscal discipline to comply to the fiscal laws of the country, and also to make sure that there is a good balance between domestic and foreign borrowing, that the debts have an acceptable average tenors, both domestic as well as foreign, and also that debt service in itself is spread across every fiscal year so that you don't have too much of a spike in one period considered to another. Secondly, there must be enhanced domestic revenue mobilization. Servicing debt will require the use of revenues. One approach to resolve the high reliance to debt is through fiscal policies that enable the mobilization of domestic revenues. But since the global financial crisis, emerging markets as well as developing countries have experienced stagnation in tax collection due to challenges in accelerating personal income tax collection, also due to informality and weak corporate as well as indirect tax performance. The performance of domestic revenue has been weak generally. There also have been improvements in some countries on tax systems and tax revenue collections, so that in some countries you see the revenue to GDP appreciating marginally. Multilateral institutions like the World Bank and IMF have provided different tools, analytical tools, to member countries that can assist with enhancing public debt management as well as public financial management administration. And there's also a very wide range of technical support that is provided to build local capacity. Fiscal and economic discipline is also important. It is important to establish sound banking and regulatory systems, predictable fiscal and economic policies. Even more critical is having the discipline to implement and to deliver on government-committed reforms. And also having learned that crises happen, and in fact, as we are right now globally, we have a poly crisis. countries must endeavor to create and preserve emergency funds. The pandemic has highlighted this as a critical requirement to have emergency funds that will deal with unanticipated local or global challenges and shocks. Sovereigns are also able to, of course, use their sovereign wealth authorities and other such safe instruments that have been put in place to not only service debt, but also to step in where there's global crisis. So in addition to raising revenues in the form of taxes, countries will need to create and ensure that they have different strong revenue streams. And this includes maximizing assets that our countries have, and we tend to ignore that we have them. In most countries, you will be able to see very clear data of what the country owes in terms of debt, both foreign as well as domestic. But you will have to be fishing for records to find what the government owns. So developing strong national asset registers will be able to create focus on how to maximize and sweat the assets that we have, and also leverage on those assets if you require to do so in terms of raising financing by way of investment and even by way of debt. So governments, especially in the African continents, are encouraged to look inwards and look at the assets that they have and how to leverage on those assets and sweat them to create wealth for its people, to create employment, but also to create additional revenue streams for the use of the country. At this point, I will want to pause on my intervention and again thank the National Institute of Credit Administration and IPAD for inviting me to contribute to this particular session.